knows more about the markets, you or the market makers? That's right, the market makers. We all know that the market makers take the spread between the buyers and sellers. And that's fair, right? Couple pennies here, couple pennies there to make the transaction work. But did you know market makers are a little bit more like bookies? They control the premium of options to put the odds in their favor. Market makers have a tell of every time they're going to take your money. Welcome to Stock Charts Trading Weekly Review. If you're currently a member, I'd just like to say thank you. If you're not and you want to get the real-time indicator trade setups, go to Stock Charts Trading and click on Indicator Alerts. The indicator that lets you know what the market makers are doing is implied volatility. Implied volatility is the gauge of how much an option premium costs. And here's how it works. When implied volatility is really high, stocks are typically low. This is the tell of the market makers. Market makers can identify the perfect buy the dip entry by what implied volatility is doing. They also know where to take profits after a big run up, deflating all of the premium out of your option, making a great place to buy puts lower, which is typically better than buying calls because it adds value to your options. Whereas market makers knew right here buy the dip, and that's why they charged you more premium, so they could steal it away from you as the stock price went higher. Knowing this information will make you millions, but you have to change your trading strategy. For more on implied volatility indicator that gives you the perfect place to buy the dip and the best entry point to sell the market, go to stockchartstrading.com, implied volatility indicator. Now let's dive a little bit deeper into implied volatility and how it can work for you. If you use Thinkorswim, this indicator is perfect for you. If not, then take your line tool and find the 50% mark on implied volatility study, giving you the same effect as this Thinkorswim indicator. The rule behind implied volatility is when it's high, it's time to buy. When it's low, watch out below. Meaning when implied volatility is above your 50 line mark, start using other technical analysis like a support channel, maybe identifying a gap into the support for a good place to take a trade. If implied volatility is low, like it is now, and the stock is going up, create a channel or a triangle to identify resistance in anticipation of the market turning, just like it did here when implied volatility was under the 50% line. JP Morgan, bear flag with implied volatility under the 50% line, sold off nicely, and again, bear flag underneath the implied volatility 50% line, sold off nicely. As you can see with the Stock Charts Trading implied volatility, it's already highlighted red, letting you know to short the market when the price action is making bear flag. Sometimes you'll get big patterns and other times you'll get little patterns, but always with the high probability of sell-off results. And why is there such a high probability? Greed. Wall Street loves to make money off you. But now that you know this, you can change and have different results in your trading. This especially works well for swing traders. Market goes down, implied volatility goes up. Market makers charge a huge premium just before the stock rallies up over 10% in one day. And notice how quickly they sold off your premium. Market goes down, premium goes up, market goes up, and your option premium goes down. Buy the dip, what do you expect? That's right. Implied volatility starts to rise up again, making this the perfect swing trade indicator. But you have to put some rules behind it. Before I swing trade, I like to look at the VVIX 2-year 2-day. With the trend indicator, I know if it's bearish or bullish trades that I want to be taking. I have these highlighted green because the market's going up right now into a bullish zone for shorting the market. This chart also shows me that we have a nice diagonal support, giving me a great idea of taking short trades in anticipation that the market will start to sell off, pushing me up into the bullish trading zone because I'll have found support. Quick side note, you could take from the highs, draw a diagonal line over, see that this last high did not touch the diagonal line, meaning there should be a significant breakout. Another way to confirm your swing trade is using the VIX 2-day 2-year, applying the implied volatility. Anything under the 50 line is bearish, anything over the 50 line is bullish. Right now you can see the implied volatility is in the bearish zone, which also has a support trend line, meaning it should bounce here and move up into the bullish zone, along with this little rally, which is bullish, that's why it's marked green, into the bearish zone of the VIX index, also with support trend line. Looking for this to break above, and as the market sells off, the VIX will become very bullish, giving us a great place to buy the dip in the future. Not now. So when it comes to swing trades, there's only two types I ever do. Bull flag pattern, bear flag pattern. As you've seen in some of the other videos, I save it to bearish, which shows me the direction of the trend is selling off. I also use the bear flag indicator telling me exactly when to get into a trade up against resistance, along with implied volatility selling off, giving you a great entry point as price sells off back into this support level where you should take your profits. Bear flag patterns. is a simple consolidation area where you enter at resistance before it sells off much lower. You can use the old support of the pattern as your first target, or the flagpole duplicated down as a longer term target. Because a bear flag pattern makes an ABCD pattern, we made an indicator to highlight that. First the flag, then the A to B, B to C pullback, and C to D completion, so that you'll be able to enter into the trades lower, making the perfect bearish flag pattern for you to make great profits. Let's review some examples. UAL 90-day 4-hour. We can see the trend indicator was going up while implied volatility was going up, highlighting both green, saying it was a good time to buy. Market went up as implied volatility sold off, giving you a nice bearish flag pattern up into resistance along with low implied volatility, both confirming red that the market should sell off from here. It did just that, coming back down into the bearish flag pattern support while implied volatility went up. Great place to take profits. In XPI 90-day 4-hour, this works on any time frame. Bearish flag patterns up into resistance along with implied volatility selling off, both indicators highlighting red. Perfect place to sell the market. As the market sold off, implied volatility went up, giving your put options value, taking your profits at the support level of the bearish flag. And again, bearish flag patterns up into resistance while implied volatility sells off, giving you a great place to buy puts, both indicators red as the market sells off below the support level of the bear flag pattern. MMM 90-day 4-hour, lots of consolidation as price action came up into the resistance of the bearish flag pattern. Implied volatility was selling off, both indicators highlighted red before the big sell-off. Notice all the value you would have gained with your option premium. Here's coin, and maybe instead of losing a bunch of money on it, you would have gained. If you were using this bear flag swing strategy, you would have been alerted that coin was getting ready to sell off as implied volatility was going lower. Both indicators were red before the 75% move. Your put options would have gained a lot of premium as implied volatility rose up. Everybody's favorite coffee company, Starbucks, perfect bear flag wedge formation up into the trend indicator resistance as implied volatility sold off, giving you the perfect place to enter into the trade lower. Trade had no problem come down to the support level of the bear flag, nor longer term support level, and sold off even more. Starbucks had another bear flag, actually two overlapping each other, seeing that price didn't come all the way back down to the target support level, stopping short. This happened, so you might want to imply some kind of trailing stop system, or since you watched the video this long, I'll show you another way. Implied volatility can help you by using old highs, drawing trend lines up, and using those areas to take profit. Another way that implied volatility can help you is when you see anomalies between the price action and implied volatility. Implied volatility works as stock prices do. Old resistance is still resistance. Support is support. Having multiple places where you can take off profits or protect your profits from being lost will keep you in the trading game longer. Last trade setup, silver, 90-day 4-hour. Bear flag indicator. As implied volatility is selling off, here's another little trick I want to show you. It's never a good idea to take a trade in the middle of the trend indicator, even though implied volatility or any other indicator says it's a good opportunity, because it's a 50-50 chance that it could go up or down. Versus taking a trade at resistance, there's a high likelihood that it will go down, even to the lower band. Even a counter trend trade will go up off of a support level, even though it didn't reach the upper zone. So here's another way to read implied volatility. When implied volatility raises up and breaks out of the channel, old resistance becomes new support. And a new support bounce off implied volatility could give you the perfect place to enter into a trade before it sells off much lower. Okay, now that you have lots of information and examples in your mind of what you should see and how you should make these trade setups, let's look at some real-time bear flag patterns. McDonald's 90-day 4 hours. We have a nice bear flag pattern showing us a topping on this with the divergence indicator. You can take your channel tool and move it upward using the resistance of the bear flag pattern to identify where to enter into a trade. Up close to the trend indicator resistance and implied volatility selling off. And remember what I said about the implied volatility. Just like a price action channel, when implied volatility breaks above, that's telling you a good indication that there's going to be a reversal. Old resistance makes new support. And just as there's a MACD divergence, we're also seeing a divergence on implied volatility. From this low to this low, we can see that implied volatility is raising up, and that's why it broke out of the channel. But we can see that price action is holding, not going any higher. This is the signal that implied volatility is starting to raise up before price action will sell off. You could draw a support line across these candlesticks and wait for price action to break below, then maybe retest this old support becomes new resistance before getting into the trade. That's up to you. For a quick in and out trade, you might want to think about the $240 mark, but you know I like to use the bottom support level of the bear flag pattern, putting you around $232, which would make the sweet spot of these two support levels. Obviously, price action can sell off much lower, down to about $220. Next trade, HUM. The trend indicator is going up, and we want a bear flag. We like it for the trend indicator to go down. We can see last time we had a bear flag, price action did come back down to the support level of the pattern, then went a little lower, catching the support level of this lower area. Right now, we have a big bearish flag, creating a really big trading channel. As we highlight the last leg of the bear flag, we can see that the implied volatility is selling off. I think HUM around this 490 to 485 level is a great place to anticipate a move down to this 162 level of support and potentially a lower level of $430. You can take more moves from the highs to lows to get the timing of that trade, which this is about 30 days, which would put you about mid-August. You might want to consider September just as some extra protection because of this earnings release. Here's another great trade setup. 90-day, 4-hour. We can see that we have the two bearish flag providing a great indication of resistance. We also have the MACD divergence indicator showing us resistance, along with implied volatility racing lower. Look how this is selling off while price action is remaining high. Implied volatility low, price action high. The next thing that comes is a sell-off. So now that O is coming down into the implied volatility support, I think this is a great place to take a trade. In anticipation, price will come back down to the price action support level of $62. Let's zoom in, which we have a confirmation back here and here, making this a very heavy support line. Drawing a diagonal channel up, you can see that price action broke out, then came back and retested, and now is selling off as a confirmation that price is going to go lower. Another trade setup happening right now, DG, 90-day, 4-hour. We can see the last time DG made this bearish flag, implied volatility was going lower, price action broke lower as implied volatility raised up. So now we have another bear flag pattern rising upward as implied volatility is selling off down to this lower support level, along with the MACD divergence showing resistance, is an indication that this is a great place to enter into a trade lower. Buy some put as price action works down, implied volatility is going to go up, making those put a lot of money. You could wait until price action break below this support level, or even create a trend line, wait for price action to come up a little bit higher, confirming this double top before entering into the trade. Some support areas for a target would be $230 off the support level of the bear flag. Obviously, this gap fill of around $220. You can be a little conservative off of this lower level around $200. Ultra aggressive on the bearish market, you might want to think about this $185. Just make sure you give yourself plenty of time. This move here took over 32 days. I would at least duplicate that to 60 days because you're anticipating that the market's going to move over 30%. 30% is a lot to ask the market to move in just 30 days. The next and final bear flag pattern is CrowdStrike. We can see last time the bear flag pattern came up into the stock trend indicator. Implied volatility was really low and the price action sold off really hard, creating lots of option premium. And as a bonus, there was a little MACD divergence, which is exactly what we have now, MACD divergence with the bear flag pattern indicator coming up into the stock trend indicator, giving you a great area of resistance to short the market. Confirmation that you should short the market is implied volatility is going lower down into the support, making options very cheap. Remember what happened last time to implied volatility? This should happen again as price sells off lower into this support level of around $130. The obvious first target would be about 20% lower at this $155 level. If you want a bigger move back down to this support or even lower into the channel indicator support level of $100, take the full move of the last time it moved over 30%. Include all of this back and forth act, which tells you the trade took over 60 days for this to move. And you should anticipate that over 60 days to move back down to these lower levels. Indicators. There's lots of different trading indicators to help you strategize to make the highest probabilities in trading. Stock charts trading is all about indicators, but not all indicators are the same. At stock charts trading, we want you to have the best indicators you can possibly have. Our indicators only work on Thinkorswim platforms. The way we help you with ongoing education to provide the best experience possible for you using the trading indicators is through our Indicator Alerts program. This gives you the ability to review the indicators and make sure that they'll fit your trading strategy before before you purchase. And if you're not a Thinkorswim user, you can use the information to still make the trade setup. Get into the mindset and the strategy of how to make these trades on your own trading platform. Webull, TradingView, Robinhood, it doesn't matter. You can use the same information to trade on your platform anywhere in the world. As always, I wish you the best in trading.